Et le public nous entend entre-temps ou
Yes.
OK. Du coup, je peux dire bonjour à tout le
Already.
monde.
Yeah, sure.
Bienvenue.
And, I will present you in a few minutes. Maybe we can wait just 1 to 2 minutes to.
Hello, Frank.
Ah, bonjour, Christian. J'espère que tu vas bien.
Tout est parfait.
OK.
So maybe we can start if we want to have a world session to discuss. So good afternoon, everyone. And on behalf of the World Organizing Committee, I may say that we are very, very pleased to welcome you for this new season of SWEET seminar. And it's also a great pleasure to open this year with a presentation on climate policy by Frank VENMANS from London School of Economics and Granham Institute. So a few words to present you, Frank. You were assistant professor in environmental economics at the University of Mons in Belgium. And now you join, so since 2020, Granham Research Institute as assistant professor. But you still kept a foot in Belgium, I saw, as you are also the president of the expert committee on climate in Wallonia. So your research focus on carbon markets, finance and policy evaluation. And today you will present us a paper co-authored with your colleagues Simon Dietz and Emanuele Campiglio, entitled Optimal Climate Policy in the Presence of Stranded Assets, Falling Technology Cost and Uncertainty. So we'll have 45 to 50 minutes to present your work, and then we'll have 10 minutes of Q&A. And so just before starting for all the participants, we have also very last information regarding the webinar. So you can now raise your virtual hand if you want to ask a question to Frank. But you also have to be aware that the seminar is recorded. So if you wish to ask a question, you also implicitly agree to be recorded as well. And so if you do not wish it, you still have the possibility to ask the question in the chat, and then I will relate to our speaker. So now, Frank, the floor is yours, and thanks again for your participation.
Thank you so much for this kind introduction, for the invitation to come and speak. I like the FARE conferences in France. I missed the last one, unfortunately, but yeah, it's a pleasure to present this for a French audience. So as Anne said already, this is joint work with Simon and Emanuele. Emanuele is at Bologna and Simon is with me at in London at the LSE. So these are the smokestacks that I saw as a child from my window. It's basically, it is the last coal-fired power plant that was still operating in Belgium. Very impressive plant. I remember as a kid we visited this and like this guy at the time was not that impressive, but like he said, like, yeah, the Ford factory just besides us, they're producing 1,000 cars per day. They're quite proud, but we, as a matter of fact, we do our 500 megawatt, and we're very proud that we make this. We allow you to put on the light and things like that, and so very big plant. They tried to convert it to pallets. But then the overtaker who was going to convert the plant went bankrupt, and today they're dismantling. This year they're dismantling the plant, and so that is somewhat part of the storyline of this paper. If we want to reduce emissions very rapidly, we have this problem that quite a few assets that we have are intrinsically related to fossil fuels or emissions in general, and they're costly to repurpose or they're costly to strand. So another motivation for this paper is to have a look at these emission parts of the IPCC report on 1.5 degrees. These are the optimal paths for no or limited overshoot in blue, and then in gray is including overshoot. So the thing that I want to show first is to have a look at the speed at which these paths go down. Like we're at 40, and in 10 years, we would be at 20, like half world emissions in 1 decade. And that's just gonna require a speed of abatement that we didn't see, and we have also take into account the cost that comes with this very fast speed. And then another thing, I'll come back to this, is that in these optimal parts of the IPCC, you typically have very large negative emissions. And so that is a puzzle. I want to write another paper about this. Like, I don't see why you can have like optimal negative emissions. One of the main reason why this is the outcome is that most of these models say minimize costs to obtain to stay within 1.5 degrees in 2100, and I don't care what happens before. And I'll show with our model that our optimal path goes slightly in a different way. So we go even more crazy maybe at the start, but these very negative emissions, they're definitely not welfare maximizing, and they're probably also not cost minimizing if you want to stay below a given target at any point in time. So this paper is a stochastic dynamic general equilibrium model. It's an integrated assessment model. And so the idea is to find the optimal emissions path. And with the optimal emission path, the optimal green investment, and optimal dirty disinvestment for the world economy. So it's a world model. We don't look into the problems of the fact that the world is a different continents are quite different with regards to emissions and abatement. And so, to the best of my knowledge, this is the first paper or model that tries to unify in one and the same model 3 elements. So the first element is risk. We have macroeconomic risk. We have disaster risk. Think of tipping points which interact with economic disaster risk. We also have gradual uncertainty of climate sensitivity. We combine this with the point that I started with, inertia of dirty capital. So the fact that if you want to abate very fast, it's going to be costlier. You're going to have like a speed penalty. And then also the fact that that abatement costs are not constant over time. So there is learning going on, and you have more or less, or in our model, we have 2 types of learning. On the one hand, spillovers from other sectors. It's just time. By waiting, some green technologies become cheaper, because there is learning going on in other sectors independently of climate policy. But then there is also endogenous learning, if you like think of photovoltaic costs that went down. They only went down because there was massification and production at large scale. And so some of our learning is a function of our cumulative abatement. So there is a wide literature on integrated assessment models, and quite recently, many papers have looked at one of these elements separately. So if we think about risk, I think Lemoine and Traeger were among the early ones to model tipping points. Then Kai and Lonsak have a whole series of papers on tipping points. The 2019 is in the Journal of Economic Policy. Sorry, I get it. Yeah, GAP, Journal of Political Economy, GPA. are papers on gradual uncertainty, so rather Brownian motions in the jargon. Van den Bremer and Van der Ploeg, Hambelkraft and Schwartz just published integrated assessment models with risk. Stranded assets. Most of integrated assessment models that look at stranded assets are deterministic. Rosenberg et al., Baldwin et al., Coulomb. But then there are also two that are integrate uncertainty. So this paper of Hambelkraft and Van der Ploeg is quite close to our model, but they don't look at optimal emissions. They don't have the ambition to really describe optimal emissions over the coming decades. They look at diversification motives between dirty and clean capital. And Van der Ploeg and Rezai is about risk specifically for the oil sector. And then learning literature. Pop gives an overview, learning literature, integrating learning into integrated assessment models started relatively early, but then, yeah, there is not dozens of papers who do that. So we are quite, I think the way we model it is quite innovative. So let me then explain the model and start with standard elements that you'll find in any model. Think about maybe also DICE for those who know Nordhaus model. Yeah, DICE does not have two stocks of capital, but since we have a model where we want to look at stranding, we need two stocks of capital, dirty and clean. And when I talk about dirty, it's dirty in the narrow sense. So it's only that part of the economy that is emission intensive, that is subject to stranding or repurposing costs. So you can think of steel mills, electricity plants, oil, gas. So a bit less than 10% of GDP, or no, 10% of capital. And so it means clean capital is all the rest. It's not only renewables. We have a Cobb-Douglas production function. Labor and capital go in, allow you to produce with a total factor productivity that grows exogenously at 2% per year. Since we are interested in risk, we use Epstein-Zinn preferences. I'll come back to that. And then emissions, very simple. It's just proportional to this dirty capital. And psi is the carbon intensity of dirty capital. And we assume that it gradually decreases over time, but would not go to zero. Would be like half, in the steady state, it would half be the intensity of today. That is just the result of the fact that even without climate policy, you have companies who would try to reduce energy costs. It's also observed in data that that capital becomes more energy efficient and also more carbon efficient. We use a simple temperature model. So temperature is just proportional to cumulative emissions. And damages are quadratic. So they are proportional to the economy, and they are to the size of the economy. And so they're quadratic. It's very similar to the damage function of DICE. We use in our results a damage coefficient that is in line with, I forgot the names, Sterner and Howard. Yeah, who do a literature review on damage functions. And so our gamma here is larger than in DICE. So our model will go to 2.3 degrees in a cost benefit setting, where DICE goes to 3.5. Good. Then we have a quadratic total abatement cost multiplier. Again, abatement costs are proportional to the size of the economy. It implies a linear marginal abatement cost function, and I'll come back to that So one of the first distinctive elements that we have in our model is the stranding or the repurposing costs. I'll explain them more in detail now. So this is a graph from the International Energy Agency, World Outlook of last year, and it's emissions from coal-fired power plants. And coal-fired power plants, it's huge. So 10 gigaton of emissions, that means a quarter of world emissions are from coal-powered power plants. And if we just stop building new ones, by the way, it's not what we're doing, then you would have an emissions path from this sector that follows the gray line. And that is very cost inefficient. So according to the IEA, it would be more cost efficient if you want to stay well below 2 degrees to follow the orange line. And so get rid of a lot of our existing plants, although they're perfectly functioning. So here is a bit of detail about the same problem. And so they think that part of these, the dark brown part is these are power plants where they think it's the cheapest option is just to abandon them. They may be old, they may be perfectly functioning, but just abandon them. And then part of this can be better repurposed or retrofitted. So one way is the thing they tried in Belgium with this plant in my hometown. You can burn pellets in coal plants. That's a cheap option. Don't requires a lot of repurposing costs. But we obviously don't have enough pallets for all these plants. So the larger part should then be retrofitted with CCS. And the key idea of our model is that although maybe you also want some coal with CCS anyway in a 1.5 degree world or a 2 degree world, but the retrofitting is more expensive than the greenfield installation. So the idea is retrofitting or repurposing capital comes also with costs. And so the example that I give for coal-fired power plants is the most important one, but there are many other examples. You can think of the distribution networks for electricity or for gas, steel mills. The zero carbon steel is going to be require quite different assets, road networks. These are all physical capital stocks which are very long-lived and are costly to repurpose, or part of this is costly to repurpose. Other part of this would be relatively cheap to repurpose. So macroeconomic investment models, general equilibrium models, they very often have already investment adjustment costs. So we have them also. So the idea is that if you invest at a crazy level and the next year you invest zero, that's going to come with some costs. So there is an incentive for investment smoothing over the years, and it's typically they assume a quadratic investment adjustment costs. And we have that, but we have something similar in the negative investment domain. So if you think about stranding, getting rid of dirty capital at a speed beyond the decay rate of capital, then you need, you can see it as negative investment, or you can see it as repurposing. So you need to get rid of your capital faster than the natural rate. And the natural rate in our model is 5%. Because we assume a decay rate of dirty capital at 4%. That is quite low, but it's because it applies to this type of industrial physical capital with long lifetimes. And then technically, if your carbon intensity also decreases at 1%, your penalty for repurposing costs starts beyond an abatement speeds of 5%. That's how you have to see our model. That's how also we fit our parameters. I'll come back to that. So if the y-axis here is the amount of capital that you want to get rid of beyond your 5% reduction you can get for free, then these costs are quadratic. And so it means repurposing a bit of dirty capital is going to be cheap. Maybe the pallet story applies, or you can recover quite a bit of the plant. Maybe it's a steel mill and you don't only need a few adaptations, or you switch from coal to gas. But at some point, you'll be at this point, R star, the slope is 1, meaning if you have 1 million of dirty capital, the cost to get rid of it is 1 million. So it's just 0 residual value from getting rid of this dirty capital. And then beyond this point, the model will rarely go there, only for 1.5 degrees and a bit of delay. Then you would even have more costs, because you can also think of wider macroeconomic costs that come with very rapid transition. So labor costs, you can think of financial costs. Some companies go bankrupt and you have transaction costs and things like that. The slope of this, or like this, the slope of this cost function is fitted to IPCC data. I'll come back to this. Second distinctive feature is that we want to get a look at the dynamics of abatement costs. So as I told you, marginal abatement costs are linear. So let me explain the 3 factors in our marginal abatement costs. Or no, sorry, let me first show you the graph. So on the x-axis, you have emissions. And so at this point, you have business as usual emissions. And so marginal abatement costs are 0. Cost you more or less nothing. You can think of an installation. You produce the same thing with a bit less of emissions because you've insulated your kiln, and it costs you nothing. The net present value of the installation is 0, or maybe positive. But then as you abate more and more, you emit less and less. You can think of expensive insulation, like insulate walls of houses. Here you can think of electric cars, and then you can think of maybe hydrogen, CCS. The less emissions you have left, the more expensive the marginal technology will become. And this is the cost corresponds to the cost today. Then if you think about this, the cost function in, say, 2050, you would have, again, a linear function, but it would have a lower slope and a lower intercept. And that's our third factor here that we add to our marginal abatement cost function. So on the one hand, you have this learning by weighting. So spillovers from other sectors, it's just a function of time. The tau here, it's synthetic time. It's basically it's a mapping of time. It's a value. It starts at 0 today. Time 0 is 0, and then infinite time it goes to 1. So you can think of this as a factor that starts at 1 and slowly goes to 1 over 2 if j would be close to 1. It goes to 1 over 1.8 if I remember well. This is something that DICE also have. So DICE assumes that as time goes by, marginal abatement costs are decreasing. But what DICE and other standard models do not have is the learning by doing part. So there is also another part of learning that depends on this capital A, it's cumulative abatement. So that's this idea, most known is photovoltaics, I think. So they typically assume that the log of the costs decreases with the sum of all past installed capacity, the log of cumulative capacity. And we have the same logic, but we use cumulative abatement as a argument for the learning curve. Good. So now, how do we get the parameters? So in our humble opinion, we think there is work to do on fitting integrated assessment models. So often it's quite difficult to have like a clear opinion on what should be the correct parameters. So one way in which we try to contribute to the debate is our fitting to bottom-up models. And so bottom-up energy models, they look really into the detail of what is required to reduce emissions worldwide, and what are the costs of all these technologies, and what are reasonable learning rates, etc. And so that is the IPCC models. They are generally bottom-up detailed energy models. And so we take 148 scenarios of the IPCC database. We only look at models that don't exceed 2.8 degrees, because the scenarios that are going really hot, they capture dynamics that are not in our optimal paths, so we exclude them. And the NGFS is also a database with basically the same models, which remind GCAP, etc. So we have 148 time series where we look at emissions, and then we both have total abatement cost and marginal abatement cost. And we apply maximum likelihood, assuming that errors to both functions are normal. Basically, you can think of it as a minimization of quadratic deviations from our models, quadratic errors between our structure that we impose and the observed costs that are in these 148 scenarios. Here are the results. Quite boring. Yeah, the key idea is that given our assumptions, you can write the total costs as a percentage of GDP as a function of emissions and then our parameters. It includes our stranded assets parameters, stranding costs parameters. And we have the same for the marginal abatement cost. So the carbon price as a proportion of production is also a function of emissions, which we observe in these models, and then our parameters. Good. We truncate the models. We disregard then the 5% of the most expensive and the cheapest cost among the models, because these models have very large outliers. So my opinion is that the truncated data are better than those fits that use all the scenarios. Good. Third distinguishing element is uncertainty. So we have 4 sources of uncertainty. So we have standard economic uncertainty. So we have Brownian motions on dirty capital, on clean capital. These are correlated. Then we also have a Brownian motion on total factor productivity. And then we have jumps, like those who know a bit the literature. The Barro paper uses jumps representing disasters. So every 35 years on average, the economy, there is like a big disaster, and the economy shrinks by 20% or 30%. It represents, so Barro fits this to observed data of the last century. Typical disasters are World War I, World War II, and then some of the deep crises. I think Latin America had a few crises, so these crises that go beyond a reduction of 20% in GDP. And this is very useful because it allows you to explain the equity premium puzzle in financial markets without a crazy value for your relative risk aversion. So since this is about optimal policy and we make normative statements, I don't like these models who require like crazy risk aversion, like with a relative risk aversion of 8, for example. Anyway, so important thing is we have disasters in our model. Now, climate comes on top of that. So we have a Brownian motion on temperature, meaning every year we gradually update our beliefs about how emissions translate into long-term warming. The uncertainty on the climate sensitivity could be captured, is captured in this way. But then there is also, we make these disasters dependent on temperature. So the idea is that in a warmer world, if there is a war, it would be slightly worse, or the likelihood becomes larger. That would be equivalent in our model. And then I told you already, Epstein-Zinn. Epstein-Zinn means that the risk aversion parameters is different to the inequality aversion parameter over time. Yeah, let's not go into the details. So this is recursive optimization. That's why it's difficult. So it's dynamic programming with 5 states. To the best of my knowledge, there is only one team that has gone this far and even further. Kai and Lonsek, they had 7 states, I think. It's very complicated. You'll see in the data. I have to excuse myself. The data is the outcomes are preliminary. There are still a bit of kinks in the results. That's because you have the curse of dimensionality. With 5 states, we need at least 1,500. A polynomial with 1,500 terms for the value function, and that's challenging. So recursive optimization means that the social planner takes decisions today, anticipating that he will then be able to adapt his plan once that uncertainty unfolds. And so it optimally anticipates disasters or the fact that maybe there are stranding costs if he thinks the world is going to be nice, but then it turns out that the climate sensitivity is worse than expected, and then he has to go crazy in emission speed. So all these things are anticipated, and that is quite different from a Monte Carlo logic where you would just average your results over scenarios. So my outcomes are also Monte Carlo outcomes. There are mean outcomes for 10,000 runs where there are different types of different realizations of the uncertainty, but there is optimal anticipation. Good. Yeah, let me go very quick. So these are the equations that we end up with. There is a production function. So emissions is proportional to capital. There is a production function that has a Cobb-Douglas structure. Here, capital is the sum of both clean and dirty, but they're not perfectly substitutable, because basically emissions here, which is the abatement cost, is a function of dirty capital. So at 0 emissions, dirty and clean capital are very difficult to substitute. And then we have the damage function. There is a Brownian motion on the equation of motion of temperature. There is a Brownian motion and a jump on total factor productivity. That's our second state. Then we have a standard equation for capital, the equation of motion of capital. This is dirty capital. The clean capital will be the same, something similar. And then the 5th state is time, which allows time dynamics and the learning, the exogenous learning in the model. Good. Then let me show you the results. So the first result compares the cost benefit in blue with a 2 degrees cost minimization. Cost effectiveness is also a name, in red. And the blue and the red line, they have a similar steady state temperature. So the cost benefit doesn't go very much beyond 2 degrees. And so my apologies. So this kink in blue, it shouldn't be there. This is a result of interaction between nodes. It's gonna vanish by getting more nodes. These results are a bit preliminary. This kink should be there because it is the moment when the stranding costs are no more binding. So let me make clear that what's the difference. So cost benefit is a welfare maximization, and it means you care about the timing of costs, but you also care about the timing of the damages. You avoided damages is your benefit. And so this is, for damages, you prefer, you discount the damages. So you prefer late damages than early damages. And therefore cost benefit will typically give you a stringent, like a more ambitious path at the start, compared to a 2 degrees cost effectiveness, where you only minimize costs for a given temperature target. So you don't care about the timing of the damages, therefore you abate later. So the red line goes less ambitious at the start, yeah, that's a general outcome. It is less ambitious at the start, and then to compensate this, it will go more ambitious at the end. And so to connect with the IPCC outcomes, the IPCC always does cost effectiveness. In the 1,000-page report of work group 3, there is half a page or 1 page on cost benefit. And so they should integrate in the future that if you do cost benefit, you have more ambition at the start. Good. What does it mean for stranded assets? So stranded assets, since you will have less ambition at the start in a cost effectiveness analysis, you will have less stranded assets, only 200 billion per year, where this is the amount of capital that is repurposed. And at low amounts, the costs will be reasonable, less than the amount of capital that you repurpose. And however, the yellow line shows you 1.5 degrees cost benefit. And that is extremely ambitious. The emissions go down very rapidly, become zero in 2060. And there is a little bit of negative emissions, but they are partly the result of the fact that we can't exactly put a constraint on states with our dynamic programming approach. So technically, the damages are 0 until 1.5 degrees, and just before 1.5 degrees, the damage goes like a hockey stick, has a hockey stick function, goes up crazy, so that the program wouldn't bring us to beyond 1.5 degrees. So the optimal path will stay around 0 in our 1.5 degree scenarios. So temperature paths are shown here, left below. Nothing special to say. The social cost of carbon, that is more interesting. So if you have a cost benefit analysis, since you go more efficient, more ambitious at the start, the carbon price starts higher and goes down, increases more gradually. Whereas the red line would do something close to what is known as the hoteling path. The hoteling path will increase at the rate of interest, the discount rate, sorry. Good. Then we have the contribution of adding inertia. So I have a model that the yellow model is now the central model that has everything. And the purple model line is what if there are 0 stranding costs. technically, I run the same model, but saying that the initial conditions are that, imagine the same temperature today, but that emissions were just at 30. So you wouldn't have this problem of existing assets that need to be stranded. So the purple is the same model, but stranding costs are set to 0. And then, yeah, you'll do abate much more at the start, and then that allows you to abate less later on. So in our temperature model, basically the emissions is the derivative, or yeah, if you take the integral of the emissions, you get the temperature, or inversely, the slope of the temperature function corresponds to the value of the emission function. And so the fact that you can't go in reality crazy, like reduce emissions by 25% in 1 year, means that you can't have a kink in your temperature path. And so until now, we were temperature was rising fast, and there is inertia. It takes time to bend this curve to go at a slower, rise at a slower pace, and then finally stabilize. The gray line is the 80% scenario. Since this is a Monte Carlo run, it shows you the spread of the scenarios. In a typical model, if there is no inertia, you want to go extremely, like if you think about dice would, with a higher damage parameter, would say, tomorrow we reduce emissions by 40%, and then we do something we decrease further very smoothly. And that's not possible with inertia. Inertia wants that you would have a delay, because in the preceding slide, we start in 2020, but 2020, yeah, like it's already gone. We started this paper in 2019. So if you think about some delay, some business as usual emissions until 2030, and then start optimal, you see that stranding costs increase by a lot. They double. Sorry, the quantity of capital that is stranded is doubled. The costs that are associated with this are quadrupled, and the difference between a model with inertia and without inertia becomes larger. In a cost-benefit analysis, it also now becomes optimal, since you've been waiting so long, to reach 2.1 degrees in 2100, rather than 2 degrees if you start in today. Since there are these extra stranding costs, the social cost of carbon is also larger, more or less 3 to 5%. The effect is not that large in our setting. We expected it to be larger, but it's obviously larger, but it's not by a lot. So to come back on this with a better view on stranding costs, what I have been showing is for 2030, if you start your optimization in 2030 and you have business as usual before, you would have a yearly stranding of $500 billion. And then the total amount of stranded assets would be 2 trillion. So world GDP is more or less 100 trillion. So that would represent 2% of a 1 year yearly GDP. And the total, sorry, I'm saying it wrong. The red is the cost. So this is the cost. 2 trillion is the cost of a total assets that is stranded of 5 trillion. And so you repurpose 5 trillion, but the cost is not 5 trillion because the repurpose, you can recover some of the value of your assets by repurposing rather than just stranding them. And so it goes up very quickly. You can compare the 5 trillion with the less than 2 trillion if you would have started in 2020. Now, what is the effect of learning? Learning may, let me explain first what's on the graph. So the blue line is a model where we switched off learning, and we fit a model without learning to the same data. And it gives you a result where basically marginal abatement costs are the same in 2060. So if you, to the same scenarios, you fit a model where you impose constant marginal abatement costs, then it will assume that the abatement costs are cheaper today and more expensive in the future. And so that creates then a scenario where there is an extra incentive to, since abatement is cheaper, there is an extra incentive to abate more today. And that will result then in more stranding costs. So the reality is that there is learning. The message is, with learning, you reduce stranding costs. It's optimal to wait a bit and to profit from the fact that in later periods, the same emission reductions are a bit cheaper. Then uncertainty. This is something that comes out of many models, and it's not widely known, and it's a bit of a puzzle. So our model in red is our model where we have set the relative risk aversion to 1.35. It means we have an expected utility model. So the risk aversion is low. So everything is the same. The shocks are there, the tipping points are there, but the agent or the welfare function is not risk averse. It's not zero risk aversion. So it's just the expected utility. It's equal to the inequality aversion. And then if we switch the relative risk aversion to 4, creating like an extra risk aversion, the effect is mild. And so so the risk aversion gives you the blue line, and you reduce your emissions by a bit, but not by much. And so you go from 2 degrees optimal temperature without risk aversion, with like low risk aversion, to 1.9, a bit above 1.9. And so many other models with tipping points find a very different optimal emission and a different social cost of carbon, because it measures the effect of adding on the mean. If you add a tipping point, your damage, the mean of the damages increases, and that obviously then is an incentive to emit less. And in here, what I show is only the risk component, increasing relative risk aversion, and that is has a mild effect for 2 reasons, I think. So the one is, this is an optimal model. So whenever there is a discovery from a Brownian motion, this model optimally adapt the next year to reduce emissions or increase emissions. There is no inertia in the decision making. And the other thing is that damages, at 2 degrees, they are 1%, or let's say 2% of GDP, but they're not as large as the volatility you can find in a stock market that would give you like these risk premia like in financial markets.
Just Frank, we have 10 minutes left.
Okay,
so if
then yeah, Christian, I see you have a question. Maybe I just conclude and then come with answer your question. So Several features typically absent in other models flatten the carbon price path. So inertia of dirty capital does it. Cost benefit compared to cost effectiveness will have this effect, and learning. If you do cost benefit and you start in 2020, you have mild repurposing costs, 1.4 trillion of dirty assets. That's more or less 1.5% of total investment. And that will give you a total cost of 1.35 trillion, and it will happen in the first decade. However, if you postpone, so if you start in 2030, that's more or less what the Paris Agreement now says. The commitments give you more emissions in 2030 than today. Then you get doubles the amount of capital that is stranded is doubled, and the cost is 3 times larger. And if you want to stay below 1.5 degrees, then the repurposing, or rather stranding, cost becomes substantial. Thank you for listening, and I'm very happy to take questions now. Good. Your microphone is off, I think.
Sorry. Thank you, Frank. Yeah, we can switch to the question. We have a question from Christian Gaulier. So you can.
Thank you, Anne. Do you hear me?
Yes. We hear you.
Okay, very good. So one question, one comment. The question is, what's your preferred carbon price for 2021? And my comments and comment question, I would like to better understand what's in the Monte Carlo simulation and what's in the learning. So I understand that you have many random variables. Some of them you learn it immediately and you do the Monte Carlo simulation on that, and some other random variable you learn it over time, or learn them over time. So one possible explanation for the low impact of risk on the optimal strategy is maybe you put too much uncertainty to be resolved immediately in the Monte Carlo simulation, and not enough remaining risk that you learn over time. But it just is a conjecture. But anyway, thank you very much, Frank, for this very nice presentation. I learned a lot. Thank you.
Yeah. So first, on the carbon price, so the optimal carbon price is very high. And I've been trying to get it a bit down. So yeah, it's 150, something like that. Or here we have even in the neighborhood, like 150. It comes from on the one hand, we have 2 degrees. So 2 degrees is difficult. But on the other hand, I think that the estimates that we get from the IPCC scenarios, they might be relatively large. But that's not, I think on the other hand, it's the best we can do. In these scenarios, you have also, if you look at 1.5 degrees, for example, we looked at 2 models that can do this without overshoot, I think Remind and Which. They both are around 8% of GDP cost. It's costly. So these detailed bottom-up models give you a quite costly picture of very deep and rapid mitigation. The effect of inertia is minor, so it's mainly just the mean cost of getting of abating, and then Monte Carlo and learning over time. As a matter of fact, there is nothing that is resolved from the uncertainty at time 0. So everything is Brownian motions and jumps that only happen over time. And then the policymaker adapts rapidly the next period, the next year, to take into account what happened. But in estimating the value function, there is anticipation. So there is an optimal strategy, knowing that in the future there might be jumps, there might be updates on climate dynamics, etc. So the very difficult part of the model is creating this value function, solving this Bellman equation, which anticipates uncertainty. And then once you have the value function, the very easy part is the Monte Carlo, and at every run, at every period, some of the uncertainty unfolds, but all of the uncertainty is unfolded over time. Nothing is decided at time zero.
Okay, sorry for my misunderstanding here. I believe
no, it's a good question.
We say Monte Carlo for me is you take you sample the parameters from the beginning, you learn at the beginning, and then you add without any uncertainty. But that's it's just a problem of wording. Yeah, but that's of course what you do is much better, and congratulations. I understand the problem.
Yeah. So that is why it's so difficult, and the outcome is also because I would completely agree with you. If we would have uncertainty unfolding at time zero, that is like a less risky world than when everything unfolds, I think, over time. Good.
We have a second question from Aude Pomeray. If you want to open up your mic. Yeah, thank you.
Yes, thank you. So I have 2 points. I was wondering whether it was possible to disentangle the effect of the different sources of uncertainty. So probably running the model with only one or some of them. Mm-hmm. And related to that, I was wondering whether, I don't think the Barrow shocks were world shock. And if you look at the special types of shocks Barrow was considering, including World War, I think if you take it at the level of the world, they were not so huge as the one that were calibrated. It was not destroying half of GDP of the world. So that actually would not help. But what do you think of this?
Yeah. Thank you so much. Sources of uncertainty, we didn't do it. So what I didn't show is we have like a very, we have an explicit solution for the carbon price, which is like 20 terms of derivatives of the value function. And we estimate it and we show all the contributions of each component. And I didn't update this. So it is meant to be there. I see typically that Brownian motions have a very low contribution to the carbon price, and that jumps have a larger contribution. And the reason I think is this fact that with the Brownian motion and you adapt automatically, immediately, that gives you, and for damages that are in percentage point of GDP minor, that would give, that's I think what's behind this. For the Barrow shocks, I like your idea a lot. So, but I'm a bit, I have mixed feelings about this, because it is true, like the shocks would be smaller if you take them on a world scale, but we're thinking about a welfare function and about how people on aggregate are living through this future. And I think then it is shocks on individual consumption that matters. So if you have one country of the world having a shock now and the other country a shock 10 years later, it doesn't mean that the representative agent should have like twice the half of the shock. So I think it should have once the big shock. But yeah, in the real world, if wars are not like all countries together, you could think of trade and some mechanisms that would, or maybe mutual aid that would make it a bit less problematic than if everything does it the same. So I'm going to think about it. One thing is also that if I use the same parameter as Barrow, I can't run the model. So my shocks are a bit smaller than the Barrow shocks. So that might be a nice explanation. But that's like pure technical. I would like to copy Barro, but then jumps are very difficult in this value estimate, value function estimated. It gives your t+1 is outside your grid. Yeah, for technical reasons, it's complicated.
Thanks for your answer, Frank. So I saw it's already 5 p.m. Maybe we have very last question or a remark for Frank. If not, so we can also give you a rendezvous for the future suite seminar that will be in 2 weeks. And I think it will be Marc Florbet from PSE. And so Frank, thanks a lot for your presentation. That was very, very clear. And thanks you all for the participation.
Thanks so much for inviting me. It was a pleasure to present for my French friends. And yeah, see you later in person when the next post-COVID conference is there.
Yeah.
Thank you very much, Frank. But you can stay with us.
Yeah.
Good. Yeah, yeah.
Thanks.
Good, good. Was it understandable? Because it's always a bit
Yeah, really.
tricky to get it.